The stock market started right around the year 1600, and stock market crashes began almost immediately thereafter. They've had stock market crashes around all sorts of things, including the infamous tulip mania, which is considered the most classic example of a financial bubble. However, the most impactful crashes did not really take place until after the year 1900. So, let's take a look at some of these market crashes and see what we can learn from them. The first crash that we can talk about in the last century is called the Black Tuesday stock market crash. This is the crash that kicked off the Great Depression. It took place in 1929, and to this day it remains the worst crash in US history. Over a 4-day period, the Dow Jones Industrial Average dropped 25%. Beyond that, the market continued to crumble for many months and ultimately lost over 90% of its value. So, what caused this crash to happen? Well, just a few years prior to the crash, margin investing was invented. This allowed investors to borrow money to buy stocks, and that, combined with a very strong bull market, led almost everybody to invest without any caution at all, thinking that the market can only go up. This over-optimism caused the market to rise about 20% a year from 1922 to 1929. When the signs of a bear market started showing, people got really scared because they were leveraged and they needed to get out of the market or they would lose their homes. The panic that followed was incredibly swift and it was devastating to watch. The danger of over-optimism in a bull market is the primary lesson that can be learned from Black Tuesday crash. But another really important lesson is that if you have money to invest after a market crash, you can get seriously rich. This was exactly what happened with Benjamin Graham. This was why he wrote the book Security Analysis in 1934, because he discovered that having available capital after a major crash enabled him to buy companies for pennies on the dollar, and so he was able to get rich with very low risk. The second big crash was Black Monday, 1987. In October of that year, the Dow Jones dumped 22% in a single day. It was a drop that absolutely came out of nowhere. Experts are still trying to figure out what happened and what caused the crash. At the time, there were some signs of slowing economic growth and rising inflation, but there was really nothing in the economic climate that would have predicted such a sudden drop. Something worth mentioning here is that just a few years prior to the crash, computer programs and trading algorithms were introduced and in the process of gaining popularity among financial institutions. This led some experts to believe that these trading algorithms were responsible for the crash. Surprisingly though, the crash only lasted 1 day and the market soon climbed back to its highs. A big lesson that we can learn from this crash is that the stock market can at times be very irrational and emotionally driven, which makes it almost impossible to predict where the market is going and what can happen to it in the future. This is so different from what they teach in college about the modern portfolio theory and how the market is always rational. The Black Monday crash teaches us that the market can at times be anything but rational. It also teaches one really optimistic lesson as well, and that is the market will usually recover very quickly from even a dramatic crash. Now, let's talk about the tech bubble crash that happened in 1999. This was a period of rapid technological development. The commercialization of the internet caused valuations of internet-based companies to just rise right off the roof. Investors got so excited about the potential of investing in the next big thing that they were throwing their money at any company that had a .com after its name. However, a lot of these companies were doomed to fail. Investors soon realized that, and by 2001, the majority of the new tech companies, no longer being propped up by investors' money, disappeared from existence. The Nasdaq lost more than 75% of its value from 2000 to 2002, and hundreds of millions of dollars of investors' money went to zero. The major lesson that we can learn from the tech bubble is that it's very important to carefully evaluate the companies that we're going to own, no matter how trending they might be. Had investors taken more time to assess the fundamentals rather than just blindly hoping they were going to be in the next big thing, much of the pain of the tech bubble bursting could have been avoided. Another crash that we need to look at is the crash that followed the housing market collapse in 2008. Over the course of that process, the financial system started to melt down. The Dow Jones fell almost 50%, and it wasn't until early 2009 that it began to climb up again. What we know about the cause of this crash is that financial institutions were giving mortgages to a lot of low credit borrowers to buy houses, and when interest rates started to rise, those people could not afford to make the payments on these mortgages. So, banks had to foreclose on many properties and try to sell them in the market to get the money back. As a result, real estate prices began to drop, which exacerbated the situation and made it impossible for the financial institutions that originated these mortgages to get their money back. Thus, some financial institutions became insolvent. Investors seeing this started to feel nervous about their assets and began to pull their money out of the stock market. And so we ended up in another gigantic crash. Fast forward to 2020, after a record 10-year bull market in US stocks, the market finally took a major crash in March of 2020. The Dow Jones lost 35% of its value in a matter of a little over a month. This crash was largely due to the impact of the global pandemic. Additionally, many economists argue that the US stock market was overvalued prior to March, which made the crash even more intense. So, what can we learn from this as investors? Well, the first lesson is that once something major happens to a market that's become a bubble, we want to take plenty of time and carefully analyze the situation before we start jumping in. We also want to focus on buying only great and high quality assets that will actually produce cash flow, so that whatever happens, deflation or inflation, those assets will continue to perform for us.